Hello again, fellow BeachBum traders. Thank you for joining us for part one of our weekly trading game plan for the trading week of October 16th through October 20th, where we'll discuss war. What is it good for? For those of you that recall the song from which this title was inspired, you will recall that the answer proclaimed in that song as to war, the question, war, what is it good for? The answer is absolutely nothing. However, we will discuss and try to help you navigate the market minefield and discuss strategies as to, again, how to navigate the market minefield during times of war and hopefully help you protect your portfolio and succeed in your trading career during times of war. So let's get started. Welcome, Brian Moritz. Thank you for joining us. Glad to see you in the live chat today. Hope you're doing well. So here's our Google document with our notes for our weekly trading game plan, part one for the trading week of October 16th through October 20th. We keep our notes for our weekly trading game plans in publicly accessible Google documents. You can find a direct link to this Google document in the description box below. In our Google documents with our notes, we have links to bonus videos, links to all the tools and resources we use for our market analysis, strategies, etc. We keep all of our Google documents with our weekly trading game plan notes in a publicly accessible Google Drive folder, so you can refer back to our notes from previous weekly trading game plans as well as this week in that Google Drive folder. And you can find a direct link also to that in the description box below. Welcome, Flip of the Shippa, Smoked Tuna. Thank you also for joining us. Hope you all have been doing well. So let's get started and we'll take a look at how the markets ended up on Friday. Go to the home page of FinBiz. I think we'll try dark mode. Please let me know if you prefer light or dark mode in FinBiz. So we can see Dow was pretty much flat, slight gain. NASDAQ had a pretty much, severe drop-off. S&P also down 0.5%, so Friday was a risk-off down day. We can see had 60% decliners, 35% advancers. We've got only 11% new highs, 88% new lows. We've only got 20% above their 50-day moving average, 80% below, and only 30% above their 200-day moving average, 70% below. So a lot of weakness under the covers. You can see profit taking in the mega cap tech, the Magnificent Seven, the mega cap FANG stocks. The only real positives was energy on Friday. And again, we see the sector rotation in and out of energy. We'll see the oil price really popped up, and we'll just be discussing oil quite a bit. So look at the recent news. Again, the war, Israeli-Hamas war. We'll talk about that. We'll also talk about, again, general strategies for navigating the minefield during times of war in general. Again, we saw oil popped up. Looks like it's up over 87. Natural gas had tested up above 330, dropped down a little bit on Friday. Saw a surge in gold. Again, we'll talk the impacts of wars on gold and silver as well. See the Dow, S&P, and NASDAQ futures are all currently pointing down. Saw the dollar strengthen, and we saw the Treasury yields actually decline on Friday. Again, a flight to safety into Treasuries. The Treasury yields have been pretty volatile, and we'll see that in the futures. And again, we'll talk about strategies both today and tomorrow on how to trade the volatility in the TLT, the Treasury market in general. Welcome to Ricky Khan, Easy Mike. Thank you for joining us. Hope you all are doing well. So now we'll look at each of the indices. SPY, S&P 500. So we see we had that initial decline the first week of October. Then second week of October, we started with a nice bounce. Again, we've talked about making money trading in October in the fall, how this the September slump tends to bleed into October, called the October effect. So, and then we saw a nice recovery. Then again, we'll see some of the economic data and also the impact of the war finally sunk in later in the week, and we got this decline Thursday, Friday. See, it's still holding up over that near-term support line, so that might provide some support, but otherwise it's pretty much in the middle of its channel. So for the week, generally positive. Again, we saw that decline the first week in October, bounce back, looks like, a capitulation tail, so that might have been the bottom at that time, tried to push up, retreated again. So again, now it looks like, a bottom uptrend, and we'll get some resistance from that longer term trend line, or the shorter term trend line, some support from the longer term trend line. Look at the Qs, NASDAQ. Welcome, Sydney Osborne. Thank you for joining us. Hope you're doing well. So we look at the NASDAQ, very similar, although it's a little bit below. Looks like it tried to break above its near-term trend line, got rejected, came back down, but again, very similar. Looks like a bottoming, probably, continued to test to break out of that near-term trend line. Got quite a bit of room above that longer-term trend line. So again, we'll see probably several attempts to break through that near-term trend line in the NASDAQ. Yep. Dow, see it broke down below its longer-term trend line, tested, tried to break back above, failed. So again, we'll see probably several attempts to break through that longer-term trend line. Again, it's got additional resistance in the shorter-term trend line. So again, we'll probably see some chop in the Dow testing that trend line, trying to break back out. But all the trends looks like, we've got a bottom and a swing back up, as the seasonality in October would historically predict. So the Russell IWM is going to be quite a bit weaker. Again, we'll talk about, risk off in times of war. So again, we saw, pretty steep decline. The Russell looks pretty weak, may go down and test these previous lows. So again, small caps, again, risk off. Again, it's going to be considerably weaker. Look at the VIX. We did have, again, a couple short pops above 20. Again, we see the VIX is elevated, trending up at this point. Again, it's testing, breaking above 20, and then retracing pretty quickly. So we see those upper wicks, pretty slim. The bodies are slim. So again, it's testing and retracing pretty quickly. And again, probably tomorrow we'll talk about various ways to trade this volatility in the VIX and other volatility ETFs as well. So we'll look at the groups and sectors. Try to zoom this chart in a little bit. Hopefully that'll help with the clarity a little bit. So again, Friday we saw the strong sectors were energies, utilities, defensive, consumer defensive. Again, risk off with safety, flight to safety, typical flight into utilities, consumer defensives. Again, purely a flight to safety, risk off move. We'll see utilities had been pretty weak going into this month. Again, saw that rotation back into energy, the strength in oil, risk off, out of technology, consumer cyclical, and communication services, real estate and basic materials kind of in the middle, flat. Again, for the week, energy, utilities, and real estate were positive. Again, the weakest, technology, communication services, and consumer cyclical. For the month, however, you see utilities were the weakest. Real estate was pretty weak. Again, I think we're starting to see a rebound, a turnaround in real estate. Again, as the 10-year Treasury yield came down, that's a benefit to real estate. See, the strongest were energy, technology, communication services for the month, and energy's been the strongest for the quarter. And utilities, real estate, the weakest. So again, I think we're seeing some sector rotation in addition to that risk off flight to safety we saw Thursday, Friday. Okay, I'll bring up the economic calendar in investing.com and we'll go over all the economic data we got for this week. And I will point out just some of the highlights that I noted. Grab a quick drink. Okay, most of the uh, highly important economic data was later in the week, Wednesday, Thursday, Friday. Wednesday, we got PPI data. We'll look at that. We see mortgage rates, and as of Wednesday, we're continuing to go up. Applications was positive. So then we got PPI data, which is producer price index, the front end of the supply chain. It was hot, so 2.7 year on year, 0.3 month on month was the core, and that's the primary one that the Fed's going to look at. So that was hot. The month on month was hotter than expected. X food, energy, and transport, however, was a little bit below previous. So again, energy, high oil prices feeding into the producer price index. So again, when you excluded food and energy and transportation, it was pretty flat to down flat month on month, down year on year. But again, this says that the front end inflation at the front end of the supply chain continues to be hot, and that should cause the Fed to want to hike rates. And in both of these cases, the market didn't really react negatively, as one would expect. The market's wanting to go up. It's a seasonality trend. So we didn't see a lot of negative reaction at this time. And then Thursday, we got CPI, which is Consumer Price Index. How's inflation on the front end of the consumer? So again, it was hot. So zero point 0.4 versus 0.3 month on month, 3.7 versus 3.6, which was flat from the previous reading. And again, the month on month did go down from the previous reading, but it's still above expectations. Jobless claims continuing was higher than expected, so the job market's weakening a little bit. Initial claims was pretty much in line, same as the previous reading. So again, the job market continues to be generally resilient, and we still have higher than expected CPI, higher than expected inflation. So again, these are reasons that the Fed would be expected to raise interest rates. And again, we got some negative reaction to this. The initial reaction was negative. Then the markets tried to rally, and then towards the end of the day, they failed. We also had some Fed speakers. Some are more dovish and some are more hawkish. Several of the Fed officials are saying that the Fed may not need to raise rates again. However, after this data came out, I think they're predicting like a 50% chance now of interest rate hike in December. So, yeah, I've been expecting, um, another rate hike. I would speculate. Again, none of this is financial advice. We're not financial advisors. It's all for education and entertainment purposes only. But again, I would expect at least one more hike this year and possibly in November. So then Friday, I got sentiment, Michigan sentiment, consumer sentiment data. It was slightly negative too. We can see their consumer inflation expectations was significantly higher than expected. 5 years higher than expected and above, 2%. It's at 3%. And the consumer sentiment in general is more negative than expected. So consumer sentiment is turning negative, below expectations. Their inflation expectations above uh, previous and above what the Fed would like to see. And so that, again, caused a negative reaction in the market. So we'll quickly look at some of the other economic data from last week in investing.com, and then the upcoming data for next week. So Monday, again, we had some Fed speakers. I'll try to enlarge this a little bit. Tuesday, again, Bostic was pretty dovish, said he didn't think we needed to hike more. We'll also talk about treasuries, so probably more tomorrow, and when we look at the futures, but the treasury auctions have been kind of weak, so treasury yields have been going up in general. And we talked about mortgages, PPI. Crude oil stocks was up more than expected, although again, oil prices continue to go up. We talked about jobless claims and CPI. Natural gas storage was a little below expectations. And again, we've seen natural gas prices are working their way up, as we'll see in the futures. Crude oil inventories was up much more than expected, but again, prices continue to go up due to the Middle East conflict in the Middle East, further concerns about oil supply from the Middle East, etc. Again, bond auctions are generally weak. The 30-year was pretty weak, so we saw the 30-year yields go way up. Talked about Michigan expectations. Also, again, we'll talk about strategies, the concerns over oil supply from the conflict in the Middle East. And now we see the Baker Hughes oil rig is now going up. So U.S. producers may be starting to take advantage of higher prices. And I would expect that rig count to now reverse its previous trend where it was going down and now start to go back up. So let's look at what economic data we're going to get next week. So we've got some manufacturing on Monday. Again, some Fed speakers. So again, that will continue to cause some volatility if they come out and say we need to hike or we don't need to hike or inflation's still too hot. The expectation, again, I expect them to do one more hike sometime this year. And my prediction, my hypothesis is for November. But again, I could be wrong. We'll wait and see. Get retail sales for September. Last retail sales were a little better than expected. We'll see if this shows any weakening in the consumer. Get some industrial production. Wednesday, typical mortgage and building data. Inventories, oil inventories, gas inventories, etc. Thursday, jobless claims data. So again, this will be an important data point to see if the job market's continuing to weaken. Existing home sales, in my humble opinion, will continue to be weak with high mortgage rates. Got a Powell speech at 12 on Thursday, so people will be seeing if Powell's going to say anything that might indicate whether they're going to hike in November, December, his views on inflation, the job market, etc. And again, on Friday, we get the oil rig counts. Again, I would expect that to go slightly up. We also have just started into earnings season, so some of the big financial companies, again, you can also see the earnings calendar here in investing.com. Let's click on the earnings calendar next week. You can see everybody that's going to be reporting. So again, we had some of the financials, the major financials, JP Morgan, Wells Fargo, etc., and they reported good earnings. They're benefiting from higher interest rates. We'll see if that puts stress on any of the regionals. I'd watch out for that. We get Charles Schwab Rio Tinto's a minor. Again, we're just starting in, so this will continue to heat up as the First Republic. So some of the regionals, J&J, Bank of America. Then we get some defense. This will be interesting to hear what they say in terms of the outlook that the war may imply in their business. So again, you can go through this. Again, it's got some more financials, regional banks. So again, see what stress there is on the banking system, etc. Then we get some of the Magnificent Seven, Netflix on Wednesday, Tesla on Wednesday. So again, we're really going to get the heat of the earnings season, and those will be market movers. So you can go through this whole list, find, those that might impact your trading decisions, sympathy plays. Again, we have a link to our video on how to play earnings, how to make money trading when earnings matter again, and earnings are going to be very important at this point, and how these various companies are impacted by the war, how they're navigating the market minefield of the war. Taiwan Semiconductors, so Thursday, semiconductors, watch that sector. Some retailers, more banks, financials, a lot of financials this week. Friday, Schlumberger, so oil. Berkshire should do pretty well. And again, then more financials, and again, more regional banks. So again, go through that list. I would highly recommend that who's reporting earnings when and what impact that might have on any stocks you're watching. Also, sympathy plays in the same sector as those that you might be watching or holding to make an informed decision. Welcome, Walter Lyons. Thank you for joining us. Hope you're doing well. Just a reminder, again, the next FOMC meeting is at the end of October, so they'll be reporting their decision on November 1st. So again, we've got a couple weeks of data, Fed speakers talking, and that will, cause some volatility in the market based on their comments, and the probabilities of a Fed interest rate hike will oscillate based on the economic data and their comments from day to day. So now we'll jump over and we'll look at the market screen in Webull. Grab a quick drink. Just a quick reminder, if you're not already using Webull, you can get up to 12 free stocks by opening and funding your account in Webull. They'll also continue to offer 5% interest on your uninvested cash in a cash account. So you see, we use Webull for our market analysis, our due diligence, the majority of our trading. And if you join with our affiliate link in the description box below, you'll help also support our community and get your 12 free stocks. Again, we like Webull. We use it for all of our trading. So I'm using the online market screen on Webull, the browser version. We can see the advancers, the histogram of the advancers and decliners from Friday. So we had, significantly more advancers or decliners than advancers, but the percentage of decline was relatively small. Again, for the past couple of weeks, we've seen a net inflow into the NYSE on Friday and a net outflow in the NASDAQ. Again, Fridays, we have a tendency to see money flowing out of the NASDAQ, probably profit taking again in the Magnificent Seven, the mega cap techs. And you can see a near-term calendar of earnings as well as dividends and splits here in the calendar section in Webull. So again, a good way to keep track of who's reporting very soon. You can see whether it's before market open, after market close, etc. So a good way to see who's going to be reporting soon and what impact that may have on your portfolio and your trading. Look at the best performing industries for the week. So again, not surprising, oil and gas, utilities, again, flight to safety, utilities, defense, positive, coal, again, energy, saw a rebound in energy, some retail, little transportation, again, energy probably, when they push the XLE, when they push the whole energy sector up, we see, all the energy stocks tend to go up. So that includes coal, solar, uranium, etc. Natural gas, positive, both natural gas and utilities. Pharmaceuticals, just slightly positive. We saw some mergers. Look at the ETFs for the week. Welcome, Mighty Soldiers Trades. Thank you for joining us. Hope you're doing well. So look at where the indices are. So down on the NASDAQ, down on small cap, down on the Russell. So again, risk off, profit taking probably out of the NASDAQ in general. So short the NASDAQ, short small cap. Dow is up. So up on the Dow, short small cap, short mid cap, again, higher risk. So you see the higher risk, we're getting a risk off sentiment. Again, and down on the S&P in general. UVXY is the leveraged ETF on the VIX on volatility. So up as we saw in the chart. Also got VIXY and other short-term futures up, BXX and other short-term futures up, spikes, so up on the VIX. Again, short on the Russell, short on small caps. FTSE's positive on Europe and China again. And again, we see down short on the NASDAQ. Industry-wise, some biotech, natural gas positive, energy in general, XLE. So again, some industrial, some healthcare, energy strong, utility strong, communications weak, technology weak, basic materials split, cyclical, consumer cyclical, negative, defensive positive. So again, risk off, flight to safety. Real estate pretty negative, again, sensitive to bond yields. Financial services, surprisingly, mostly negative, even though the major banks reported positive. Most of these financial services are showing negative, XLF, so though the general sector is slightly positive. Welcome, MD. Thank you for joining us. Hope you're doing well. So commodity-wise, grains positive. We'll see looks like a bottoming action, a swing back up in several of the grains. Oil positive, so all oil, gold. We'll see the rebound in gold and silver, so gold, grains, oil. Bonds, Asia, 25, the long end of the curve. Again, we're seeing this D inversion of the curves, the long ends moving up. gold, extended duration. So again, the long ends are tending to move up. And the foreign currencies are recovering slightly. So we'll see a slight downturn in the dollar, slight upturn in some of the foreign currencies. So we'll go ahead and look at the futures in FinBiz. So again, we see that seasonal downtrend first week of October, then a nice bounce in all of the indices. So again, we talked about this seasonality, the October effect, this seasonal uptrend tendency historically in October. So we kind of saw that play out. And then again, with the hot economic data as well as the concerns of war in the Middle East, to cause a little bit of a downturn. Saw an attempt to rally and then a failure in general. So it looks like they've all kind of rolled over. We may, get a downswing. We'll see if it makes a higher low. See, the S&P kind of tested that previous low, got rejected, downturn. We'll see, where it swings back up. So we'll have, some potential short-term downtrending, and then we'll wait for that bottom and the swing back up again. Russell much weaker, broke down. Looks like it's at or below its recent low. May continue to break down. We see that, tendency to short the Russell. So the Nikkei recovered and then rolled over. Same thing with the Euro stocks, the DAX. Saw that spike, above 20 briefly, got rejected. So it looks like, the VIX keeps trying to break above 20, isn't able to hold, and then breaks down all the way below, 18. So it really needs to hold the bottom above 18, break 20, hold 20 before we get some elevated volatility. Again, we see oil spiked up. I believe it broke 88, got good support at 85. So I would expect, continued support around 85, testing, potential 90, previous high at 95. Again, we saw natural gas broke briefly above 340, rolled over, trending down. We'll see if it holds at the previous low just below 320 and turns back up, or if it's going to, break down further to 3. 3 looks like pretty good support. So we'll look at the ETFs to trade oil, natural gas, etc., which is also part of our strategies for navigating the market minefield during times of war. Again, we see that strong surge in gold and silver. They had already started to rebound, and then we saw that surge on Friday. Again, risk off, play to safety, typical commodities people fly to in times of war, times of fear. Palladium kind of bottoming, platinum similarly. Some of the grains, you can see corn slowly uptrending, popped up a little bit on Friday. Wheat looks like it's still forming a bottom, did pop up slightly, but again, it's chopping along a bottom. Looks like it's trying to form a stable bottom. Hopefully that'll turn into an upswing. Lumber pretty flat, oscillating. Then we see the treasuries. And again, we'll look at some of the individual ETFs for treasuries, TLT, etc. Ways to long and shorts the treasuries. But we saw the prices were recovering. Then we saw that volatility due to both the economic data, the hot inflation says the Fed needs to raise rates, which drives the bond yields up, prices down. And then we see that flight to safety where people buy bonds, so then the prices go back up and yields come back down. So again, on Friday, we saw flight to safety, buy bonds, and I believe that was why we saw that recovery in bond prices. Again, dollar's been relatively strong around 105, 106. We did have a downtrend, and then flight to safety, risk off, some flight to the dollar as well on Friday. See, the Japanese yen's pretty weak. Euro has been 105, 106. Okay, I'm going to jump forward to our strategies because our strategies will involve looking at some of the detailed ETFs. So let me grab a quick drink and we'll talk about our strategies for this week, or what is it good for. Again, as the song that inspired the title says, absolutely nothing. But again, we want to talk about some strategies about how you can navigate the market minefield during times of war. So let me grab a drink a second. We'll continue. Welcome, Alan Krantz. Thank you for joining us. And yes, that's what we're going to talk about is the wars in general, some additional risks, sectors that might be, it might be detrimental to, sectors that it might, I hate to say war is positive or anything, but some sectors that may go up during times of war. And in particular, we'll look at the current ongoing conflicts, the Israeli-Hamas and also the Russia-Ukraine. So in general, during times of war, and again, we saw this both previously in the Ukraine-Russia conflict and also in the Israeli-Hamas current conflict, the flight to safety, risk off. People tend to go to, when they do this flight to safety, risk off, they tend to go to U.S. Treasuries, perceived low-risk stocks like the Magnificent Seven. So earlier in the week, we saw the Magnificent Seven, the mega cap techs, get a boost, Microsoft, NVIDIA, etc., irregardless of other factors. That's perceived as a new risk-off move. Again, we saw that surge in gold and silver. Again, typical flight to safety, risk-off move. They fly to gold and silver, and it's a negative or higher risk asset. So again, we saw technology in general get hit. We saw the Russell IWM. So again, higher risk, perceived higher risk assets it's going to be a negative for them. It's positive, obviously, for defense stocks. So we'll look at the DEFN ETF. We also have another, I think it's ITA is another defense ETF. Also, your typical major defense contractors, Lockheed Martin, Northrop Grumman, Raytheon, etc. You've got ammunition stocks like POWW. You heard the need both in Israel and Ukraine for ammunition. Also, you're hearing, nowadays war also includes, cyber attacks, so as well as normal security. So you'll see a boost in companies that provide security, cybersecurity like Palantir, etc. And it's a big negative for international travel. Obviously, people are not going to travel to regions where there's an ongoing war, and it'll have a potentially longer term impact of concerns. People are not going to want to travel. They're going to be concerned to travel to the Middle East more so than prior to this war due to what's happening, the continuing instability, etc. So specifically, so again, when we talk about international travel, that impacts international airlines, cruise lines, resorts, etc. Anything having to do with travel to those regions. So it's good to Alan was asking about sectors to avoid is travel, particularly international travel. We may see a shift more towards some domestic travel. We'll see. Specifically with this Israel versus Hamas war, obviously we saw the impact on oil. Oil surged back up over 85, continues to uptrend even though we're getting more storage supply, more rig counts. The price of oil will probably continue to go up due to concerns of the impact on overall supply. Also, Alan, as you were mentioning, if the war expands, includes Iran or further sanctions or just more um, actually enforcing sanctions on Iranian oil and or Russian oil will curtail the supply, and that will drive oil prices further up. So again, oil will probably continue to go up due to concerns in the region regarding this conflict. Also, it was interesting, I heard concern about Iran participating or being involved in the war was that there's a significant amount of liquefied natural gas that comes out of Qatar, goes through the Straits of Hormuz, and the Iran in the past has mined that straits or captured ships in those straits. So if they impede the supply of oil and or natural gas in that Straits of Hormuz, that might also cause uh, up to a further, increase in natural gas prices. Also, there's concerns over companies based in Israel, based in the Middle East, etc. Are their employees being recruited or called up or participating in the war? Is it impacting their companies, ongoing business for those companies? And what are the concerns relative to that? And we're going to look at some Israel. We'll talk about Israel-based and Middle East-based ETFs. And again, a reason I wanted to do our strategies prior to looking at the individual ETFs. Also, as we saw with the Ukraine versus Russia war, we saw an upsurge in wheat and some other agricultural products. Again, there's an ongoing debate whether they will continue to have a deal to allow Ukraine wheat out. So that may cause, again, a catalyst for increased wheat prices and possibly other agricultural products. And again, this war is ongoing. And we also saw natural gas. There's, discussions about if any supplies of natural gas are going to come out of Russia to Europe, and then we'll see if the winter of Europe is colder than it was last year. That may also drive up natural gas prices. So again, I hope this helps identify some sectors that may go up or down based on wars in general, and also the current ongoing wars in the Middle East and in the Ukraine. So just in general, before I jumped back to our ETFs, other strategies to be aware of. We talked about the seasonality trend in October, so you can refer to our previous discussions and videos on how to make money trading in October, make money trading in the fall. So again, we have links to all those previous videos in the notes, so you can quickly reference them there, and also on our BeachBum Trading YouTube channel. So now I'll go back to our ETF Google Sheet, and we can look at some Israel, Middle East-based ETFs, as well as those involved in these sectors that we identified that may be impacted by wars. And grab a quick drink. If anybody has specific sectors, industries, topics you'd like to look at our ETFs Google Sheet, please throw those up in the chat. I'll try to also cover those. Also, just a quick reminder, as you can see, as we identify these strategies, particular commodities, topics that we want to then identify ETFs or individual stocks to take advantage of those opportunities. We use this ETF Google Sheet, and you can get 24 by 7 access to this Google Sheet, so you can use it similarly by joining our Patreon at the All Access or VIP level. You'll also get access to our dividend payers and our puts ROIC, other tools and resources that we develop available to our Patreons. So you can find a link to our Patreon in the description box below. And again, we always appreciate the support for our BeachBum trading community by our Patreons. So first I wanted to talk about, and then we'll take a quick look at some Israel-related ETFs. I did a search for Israel-related ETFs in the ETF database. Again, this is our primary place we go to look for ETFs, new ETFs to potentially add to our Google Sheet for a particular topic, commodity, etc. So you can click that link in our notes. It will take you to this search that I've done specifically on Israel. So you can see if you select a region, you go down to Middle East, you can identify those that are available in the Middle East. So you can see there's 4 in Israel, and we'll look at these in our Google Sheet. Let me zoom this up a little bit. So you can see there's EIS, IZRL, which is the ARC Israel Innovation Technology ETF, ITEQ, and ISRA. So again, I copied these out of the ETF database and did the risk reward profiles in our ETF Google Sheet. And you can also see there's 9 total in the Middle East. So you can also see other countries that might be potentially impacted. So here's a Saudi Arabia. Here's a Qatar. We talked about that. And potential impact if that Strait of Hormuz gets impeded, and the impact on their liquefied natural gas business. UAE is also, I believe, bordering on the Strait of Hormuz. So Pakistan, not truly Middle Eastern, another Saudi Arabia. So as you hear news about these various other countries in the Middle East, you can easily jump to the ETF database, look at these other ETFs if that's something that you might be interested in trying to trade, given the news as it comes out on the Israel-Hamas war. So again, I copied those into the bottom of our ETF DB sheet in our Google Sheet. Did a quick risk reward profile just to see the 52-week profiles for those. So here's the 4 from Israel. So you can see their current prices, lows, highs, and then also their 52-week range. So you can see, not a whole lot of risk reward from a 52-week standpoint. You can see also their decline. Obviously, when this war was initially announced, these Israel-based ETFs took a hit. And you can see with the escalation, recent escalation, possibly going into a ground war, they've also decreased. So you can see, they're pretty close to their 52-week low. So as this evolves, if you want to play the swing back up, you can see the 52-week risk reward on each of those. and you can access their direct profiles via the links in the notes. So again, I didn't add any of these to our main sheet as their 52-week risk reward really doesn't meet our two, we like a risk reward of 2 at least, criteria. And again, this is, a particular incident, and Israel is not generally an area that we'd be looking at. So if we jump back to our main sheet, and we talked about DFEN, defense. So again, you could see it's, it was down a little bit on Friday, but it's a little bit higher than, gotten a little bit of a pop out of those initially. I know Lockheed Martin, Northrop Grumman, etc., got a little bit of a pop on the announcement of the war, and then there's probably some profit taking later in the week. Also in the research tab, you can see this ITA, so that's another aerospace defense ETF. So you can see its risk reward profile is not as attractive as DFEN, but you will hear people talking on the news about ITA, and it also behaved similarly, got a little bit of initial pop, and then as you can see on Friday, retreated somewhat. Let's talk about oil, natural gas, etc. So again, we talked about the impact on oil. So the leveraged ETFs we tend to like for long oil is Gush or UCO. UCO is 2 times, Gush is 3 times. I guess Gush is just 2 times as well. We prefer Gush. You can short with DRIP or SCO. So again, we're going to see volatility in oil, so you can, short-term trade. Again, the trend will probably be up. If you want to hold oil, get a yield. USOI is a Credit Suisse ETN, pays a monthly dividend on oil. And we talked about natural gas. You can long with oil, short with cold. You can also use UNG or UNL. We talked about gold and silver. On Friday, I saw those pops in gold and silver and posted several places that if long gold, our preferred leveraged ETF is GDXU. For silver, it's AGQ. You can see you also have some miners. JNUG is our preferred miner ETF. I believe there's also another one people mentioned, JDXJ, I believe. Yep, JDXJ. Again, not as attractive risk-reward profile, but we do have it on our research tab. So if you don't find a particular ETF in our main sheet, it's probably because we've either done research before or haven't. And if we have, you can find it on the research tab and see the risk-reward profile of those. But we tend to pick the ones we prefer and put it in our main sheet, and we hope that helps you as well. Also talked about treasuries, and we'll again talk about treasuries, probably so again, silver, AGQ long, ZSL short, SILJ for miners. And in general, the gold and silver miners really have not they haven't participated in the rallies as much. I don't know if they're lagging, and we'll see more of an uptrend in the gold and silver miners, but they really haven't participated as much as the commodities themselves. Also, again, when people mention that, why would you hold gold and silver? It doesn't pay any dividend, doesn't have any yield to it. If you would like to get yield holding gold and silver, there's a couple ETNs that we hold. For gold, it's GLDI. For silver is SLVO, and these pay a monthly dividend. So again, if you want to get a yield from your gold and silver holdings, you can use GLDI or SLVO. And we talked about the volatility, and we looked at the volatility of the treasuries. Here's the main TLT. You can see it's now above its 52-week low, had been making new 52-week lows. Again, we saw that risk off, play to safety on Friday, so it popped up a little bit. If you want to play that volatility, In the treasuries, our preferred leveraged ETF is TMF. We have a long-term holding position in TMF. You can play it short using TBT or TMV, and we prefer TMV as it provides for shorter term trades, as it provides more leverage. You can also see some ETFs we have for trading other than the 20 year. So if you want to trade the shorter term, the 7 to 10s, and there's also a zero coupon 25 year. Talked about the dollar. We've got some of those. We will also be talking about utilities again tomorrow. We saw that sector rotation back into utilities. We'll be looking at more detail on the chart in UTSL. It's one we're watching right now. I've talked about that for several weeks for this rotation, seasonal rotation back into utilities. The VIX, long, UVXY, again, several short, SVIX, SVXY. Talked about wheat, WEAT, and then we've also got some for trading foreign currencies, etc. I'm just checking the chat. If I missed your question, if you have ETF you want to quickly look at today, please throw that back in the chat. I apologize if I missed it previously. Just another quick note. Thank you, Stonks for Days, pointed out a new ETF on uranium and nuclear energy titled NLR. So we put that in the research tab of our Google Sheet. So it's another uranium ETF. It doesn't really have as attractive a risk-reward profile as some of the others we have, but you can see what the risk-reward profile is of NLR in the research tab. I still prefer URNM, URA, etc. So we have several ETFs for uranium already in our ETF spreadsheet, and you can see the risk-reward profile of URA, URNJ on uranium miners, URNM on uranium mining. So, but another alternative you could consider if you want is this NLR on uranium nuclear energy, and you can always look at the detail holdings, the profile via the link in our Google Sheet. So I hope that all helps. So, okay, we'll wrap up for today. If anybody has any other ETFs, any other stocks you want us to look at tomorrow, please put those in the comments below this video. Again, you can put them in our Discord. Our Discord's free to join. We can continue these conversations in our Discord. You can find an invite to our free Discord in the description box below. Also, in the links section on our homepage. Our homepage is beachbumtrading.com, bum without the U. And again, you can find invites to our Discord. Also, we have a Facebook group, a Reddit community. You can also find links to our social media sites. So plenty of ways you can contact us, and we can continue these discussions. You can ask us any questions. If there's other ETFs you'd like us to look at, do similar research on for consideration for inclusion in our ETF spreadsheet, we can do that. And please let us know how we can improve our weekly trading game plans, our videos, any of our tools and resources, and add value to all of our fellow BeachBum traders, grow our community. We'd appreciate it if you would like this video and share it with others. We continue to strive to grow our community for the benefit of all of our BeachBum traders. So we'd appreciate it if you'd continue to help share this with others as well. And we hope you'll come back for part 2 tomorrow, same bat time, same bat channel, Sundays at 10 a.m. Eastern Time, where we'll be selecting our top swing trading stocks to watch, stocks in our bullpen, our shopping list. We'll also talk about our dividend payers and our option strategies to, again, help navigate the market minefield during times of war. So we hope this all helps, and good luck and have a great day.